Hey, what's going on everyone? I'm Jonathan Wang and this is Motivational Money. We're going to talk about the one thing that everybody wants, money, in ways that shape out a mindset that can help get you to where you need to be. In this episode, we'll crack open the Da Vinci Code of financial statements with just 4 key questions. When it comes to investing, it's commonly understood that financial markets can be unpredictable. Some days it feels like you're on top of the world, and other days it feels like you're stepping into the ring with Mike Tyson. You know how in boxing the referee says protect yourselves at all times? Same goes in investing. You are stepping into the ring with an unknown adversary. Unlike boxing, it's not 12 3-minute rounds. Your objective is to stay in it for as long as possible. What this means for you is that you need to have an infinite mindset. The most important thing to do at all times is protect your very own peace of mind. It just takes one slip for years of progress to be wiped away by market volatility. Some live for this and some unfortunately have died by it. Without an infinite mindset, you're just flying by the seat of your pants, hoping that somehow you'll land on your feet and your portfolio will be in a better place. You could roll the dice that way, but why give yourself the unnecessary stress? It's like driving without understanding any of the basic traffic signals. You could do the responsible thing and just learn a little before you jump behind the wheel. I mean, you're not trying to win the Monaco Grand Prix. You're just trying to navigate your portfolio to get from point A to point B without getting killed. Imagine you come up to an intersection and the colors of the lights are not red, yellow, or green like we would normally understand them to be. They're blue, purple, and white. What are you supposed to do when you don't even know what the traffic signals mean? You would do your best to read traffic, right? You look left, you look right, and then left again, and just go for it. But even that depends on what country you're in to determine which side of the road you're supposed to be driving on. This is what many retail investors are doing when they don't understand anything about financial statements. Market volatility is the undeniable force that everybody wants to be on the right side of. Hate it or love it, you can't avoid it. But we can plan around it by asking 4 simple questions about a company's financials. These 4 basic questions give us a red light, green light on a company. They don't get asked enough, and it's what drives markets crazy when they don't get asked at all. Here are the 4 key questions to understanding the 3 financial statements. The first financial statement is the income statement. Right off the top, it tells us how much a company makes. This is called the revenues. The first key question to consider, is it growing? Without an MBA, do you want to buy a company that's growing in revenues or shrinking? You might say growing, and you are correct. What that means for us is that we want to see a company making more and more revenues over time. Public companies on American markets report on a quarterly and annual basis. All of these reports are required by law to be made accessible to the public for free. What this means for you is that you can see if a company is growing in the short term on a quarterly basis, or you can see if a company has been growing over the long term, over many years on an annual basis. Now, you have options. You can choose to invest in companies that have been steady over the past couple of years, but suddenly had explosive growth in the most recent quarters. Or you could choose to invest in companies that demonstrate consistency over time with moderate growth. The most important thing is that the company is growing. It would be crazy to invest in a company hoping that the stock goes up when its revenues are just spiraling down. If you're short selling the company, then this might be exactly what you're looking for, because short selling makes money when the stock goes down. Growth is what investors generally look for. Focusing on growing companies points you in the right direction. The second key question to consider, is it profitable? As you go down the income statement, you see all the lines that tell you what the company spent its money on. These are called expenses. You know that phrase, the bottom line, just get to the point? That's a phrase that comes from the income statement. The bottom line refers to how much money the company made after all expenses are paid. Take the top line revenues and subtract out all the expensive. That is your bottom line. It can also be called profit, net income, and when divided by the total number of shares the company has outstanding, earnings per share, or EPS. If it's positive, the company made money, it was profitable. If it's negative, the company lost money, so it's not profitable. Much like personal income, it doesn't matter how much you make if you spend beyond your means. Same in business. It matters what you could put into the bank, because that's what you could put into the pockets of shareholders. If a company doesn't get a handle on the excessive spending, that leads to bankruptcy. Do you want to buy a company that continues to grow its profits or widen its losses? Now, we can start to be picky with just these 2 key questions. If I'm on the conservative side, then I want to invest in stable companies that are growing both its top and bottom line each quarter and every year. If I'm on the aggressive side, then I'm looking for that next rock star, the next headliner. Then I want to invest in companies that have explosive growth in revenues. It might have heavy losses, or it might have narrowing losses. It might even have the occasional 1/4 shimmer of profitability. If you see the potential for a company to one day consistently turn a profit, then that's a diamond in the rough. But how long long do I hold on to this before it becomes a dud? Not about how long you hold on to it, it's about how long before the company runs out of runway to continue. How do you gauge that? The third key question to consider, is it liquid? This is the ability for a company to meet its short-term debt obligation. Short-term meaning within the next 12 months. Now we're talking about the balance sheet. The balance sheet tells us how much a company has in assets and liabilities. We only need two lines to determine liquidity: current assets and current liabilities. Current assets are either cash or cash equivalents, which are assets that can be quickly turned into cash within 12 months. Current liabilities are debts due to be paid within the next 12 months. Take the current assets and divide it by the current liabilities. This gives you the current ratio. A current ratio tells us how many dollars in cash a company has for every $1 it has in debt. If the current ratio is greater than 1, then the company has more than enough to meet its short-term debt obligations. If the current ratio is less than 1, then the company only has cents on the dollar for every $1 it has in debt. That's really bad. What happens if a company continues to lose money and its current ratio is under a 1.0? Well, it's going to need cash. It can either borrow from the bank, which is really expensive. It can issue corporate bonds, which is also expensive. Or it could just sell more shares, which is less expensive, but this really upsets shareholders because it shows that the company wasn't able to grow and generate the cash flow to fund its own operations. It's telling the current shareholders, hey, we need you to cough up more money to buy more shares if you don't want your ownership to get diluted. That sucks. All shareholders have an expectation for the company to grow, be profitable, and flourish as a self-sustaining business. If a company is insolvent and doesn't have the means to meet its short-term debt obligations, this is a clear sign that it's on a very short runway before it needs a fundraising event. It's not necessarily doomed forever, it's just going to take a bit longer than expected for the company to achieve its milestones. If you see that a company is running out of runway, then there's no rush to jump on it now. Companies that last don't happen overnight. It's going to take time for companies like this to take off and establish a track record of success. The clearest sign of this is on the statement of cash flows. The fourth key question to consider, is it cash flow positive? Cash flow tells us how cash is flowing in and out of the business. Negative cash flow means that the company is paying out more cash than it's receiving in. Positive cash flow means that the company is adding to its cash reserves, allowing it to reinvest in the company, pay out money to shareholders, or settle future debt payments. Each of these four key questions keeps you grounded with financial fundamentals. They are all simple yes or no questions that could be answered at a glance. Answering these questions are what provide you peace of mind with your strategy. Here's a metaphor. Imagine you're sitting on a stool. It has 4 legs. Each of these questions represents one of the 4 legs your peace of mind rests on. For each question that you answer no, take 1 leg away. It doesn't matter how you mix it up. A stool can still stand on 3 legs, but with 2, you'll always be on edge with at least 1 foot on the ground. With only 1 leg, you'll never be at ease. Both feet are on the ground, and it's just a matter of time before you tip over. Now think about your portfolio. How are you feeling? Give yourself the peace of mind you deserve for all the time you're putting into your financial journey. Focus your time on companies that give you yeses. No ifs, ands, or buts. You're in control. Too many unsuspecting investors get blindsided by companies that don't have a leg to stand on. If only they knew that the answers to these 4 key questions were accessible to everyone for free, they might have had a different approach to navigating around market volatility, protecting their very own peace of mind. Everybody remembers their most painful losses, whether it's a loss from a trade or losing out on a trade. The pain from losing far outweighs the good of winning. When you invest, keep in mind that you're investing 2 valuable assets, your time and your money. Don't just measure your success by the returns on your money, because your losses will actually teach you far more than your gains ever will. The time you spend going through your losses are what give you invaluable lessons that you can then teach. So don't ever discount your losses. You can always make money back, but time is a whole different animal. You can't get that back. I make it a point after every single losing trade to do a post-mortem write-up. This is where I outline everything that happened, identify a root cause, and provide a corrective action so that this kind of event doesn't happen again. So long as you don't quit, you don't lose. You either win or you learn, and those lessons are what make the time worthwhile for your future. Dennis Waitley said it best: time is an equal opportunity employer. Each human being has exactly the same number of hours and minutes every day. Rich people can't buy more hours, scientists can't invent new minutes, and you can't save time to spend on another day. Even so, time is amazingly fair and forgiving. No matter how much time you've wasted in the past, you still have an entire tomorrow. Your time is valuable. Don't waste another minute dwelling on the past. Remember the good, learn from the bad, hope for the best, but plan for the worst. These 4 questions focus your attention on quality investments with solid financial fundamentals. That way, you don't waste another dollar on things that don't have a leg to stand on. Friends, now that financial fundamentals have finally come into the spotlight, how do we empower ourselves to do more with what we never knew we already had in the palms of our hands? How do we take these 4 key questions to the next level and start building badass metrics to evaluate a company over time? Until next time, I'm Jonathan Wang. Stay sharp. Stay safe, everyone.